Welcome back to Wealthy Business, where we decode the world of finance, global markets, and personal growth. Today, we're taking a closer look at a developing geopolitical crisis that could shake the foundations of global trade and investment: the escalating conflict between Israel and Iran. On the surface, markets are showing surprising resilience. Global equities rallied, oil prices spiked but didn't go parabolic, and investors seem calm. But should they be? Are we collectively underestimating the risk of a wider Middle East war and its consequences? Let's break this down. What's happening? Israel and Iran have entered their fourth straight day of trading fire. This follows Israel's airstrikes on Iranian targets last week. The situation has turned deadly serious, with hundreds reported dead and tensions climbing rapidly. Yet global stock markets, including European indices, US futures, and even Middle Eastern markets like the Tel Aviv 35, are largely up. Brent crude saw its biggest one-day jump since Russia invaded Ukraine, but prices are still far from the highs of early 2022. Why aren't markets panicking? According to Russ Mould of AJ Bell, markets are struggling to price in the true risk of a broader Middle East conflict. The outcomes are so severe they're almost unthinkable. Hence, investors prefer to stay optimistic, or perhaps in denial. Strategists like David Roche of Quantum Strategy warn that this won't be a short-lived skirmish. Unlike Israel's past lightning strikes, this conflict has the potential to drag on, creating massive uncertainty, especially for the energy markets. Energy markets on edge oil supply is the immediate concern. The Strait of Hormuz, through which millions of barrels of oil pass daily, could become a flashpoint. Any disruption here would send energy prices soaring, with ripple effects across industries, economies, and households worldwide. That's why Roche suggests that the current lull in escalation might tempt markets into a false sense of security, a dangerous miscalculation in his view. Could this escalate? Some voices, like Deutsche Bank's Jim Reed, highlight that both sides have so far avoided the most extreme measures. He points to historical patterns. Typically, the S&P 500 dips 6% in the first 3 weeks after a geopolitical shock, but recovers within another 3 weeks, if escalation is avoided. Philippe Gisels of BNP Paribas Fortis also believes markets are right to avoid pricing in a U.S. entry into the conflict or a Strait of Hormuz blockade for now. But he cautions, should events spiral, markets could be caught completely off guard. Investor takeaway. What does this mean for you as an investor or business leader? Stay vigilant. Geopolitical shocks often bring sudden volatility. Energy exposure. Look at how your portfolio is positioned. Roche suggests energy assets may serve as a haven if tensions escalate. Don't chase rallies blindly. A calm market doesn't mean the risk is gone, just that it isn't priced in yet. Final thoughts. At Wealthy Business, we always remind our viewers that understanding global risk isn't about fear, it's about preparation. The Israel-Iran conflict is evolving rapidly. It's essential to follow credible sources, stay diversified, and think long-term. If you found this analysis useful, drop us a like, share your views in the comments, and make sure you subscribe for more in-depth discussions on global finance and economic trends. Until next time, stay smart, stay prepared, and keep building your wealthy future.